Hi, I'm Mark Jarvis, CEO of Giga Metals, and welcome to our corporate presentation. This disclaimer can be reviewed in more detail at our website. So we're a small junior mining exploration and development company with an extremely large project. We're listed on the TSXV and the OTCQX, which is the most mature level of the OTC market in the United States. And we've been working on developing this project for many years now. It is due to the surging demand for batteries and for battery materials. This project, I feel like the time is now. We're operating on the theory that the project will get built this market cycle. Whether it will or not remains to be seen, of course, but that's what we all believe. We recently completed a PEA that modeled building up in stages to a nameplate capacity of 37,000 tons a year of nickel in a 18% nickel, 1% cobalt concentrate with a 37-year mine life. That's a very, very large project indeed. And it's typical when you've got a very small company with a very large project that it's challenging because every stage of development is capital intense. And so we're at the stage now where we are seeking strategic partners to invest at the project level to help us advance this project to shovel-ready status. We're in a very attractive mining jurisdiction, strong ESG practices, including environmental assessments. It takes a lot of work to get a project approved, but you definitely can get projects approved in Canada and built. You just have to conform to the very highest environmental standard. And we are well located. It's a semi-remote area, so we won't be really disturbing any communities. None of those sorts of issues will be involved. And we've got access to transportation, in various ways. And we're surrounded by producing mines and by exploration projects. Very, very active mining jurisdiction. Our project highlights, I like to focus on the simplicity of the flow sheet. Crush it, grind it, and use froth flotation. It's very similar to, a large copper porphyry project where you're, doing open pit mining in volume, and then you're crushing, grinding, and using froth flotation to produce a concentrate. The only difference is really that we're using different reagents for the froth flotation. What we modeled is making a concentrate and selling it to a smelter, which is kind of the traditional established market. And we'll talk more about other markets later. This will be a project with very low carbon intensity. And we are funding research and doing research in conjunction with the University of British Columbia that shows a pathway, a very possible pathway to carbon neutrality. We've got empirical data to back that up. Again, the project's very large with about 5 billion pounds of nickel contained in the measured plus indicated categories, along with the cobalt. In the inferred category of mineral resource, we've got, another 5 billion pounds of nickel. So, extremely large, low grade, low strip ratio, good recoveries for this deposit type. Things balance out. So in terms of the large undeveloped deposits of the world, we are quite competitive. Here's our timeline. I myself think this is a bit pessimistic. It depends on financing. So if we can get our feasibility and environmental assessment done by 2024, well, it's about a 2-year construction schedule, shall we say. So we're, in this timeline, we're giving ourselves 2 years to put the financing together. It could happen more quickly than that, particularly in a good nickel market. So this is what we modeled making. We can reliably make an 18% nickel, 1% cobalt concentrate that's extremely low in deleterious elements. And we modeled making this concentrate and selling it to a smelter because that's a market that exists. And we're trying to keep ourselves within actual markets, not theoretical markets that may come in the future. One thing that's emerging, though, right now as a market is mixed hydroxide precipitates. And so what we're starting to look at now is taking our concentrate and processing it further to a mixed hydroxide precipitate. And the reason we're doing this is that this is emerging as the chemical form of nickel that battery makers want. So it's a relatively small market right now. It's growing quickly. And as fast as you can produce MHP, they buy it. So part of this is that we think that the extra payability for the nickel and cobalt in the MHP will more than pay for the extra capital and operating costs of producing it at our project. So we think this will enhance our economics. So these studies are underway. There's a very good chance that this is what we will model as we advance the engineering to pre-feasibility. Now, by the way, historically, we've done work to produce MHP from concentrate, and we produce a very nice high-grade MHP. It's a high-quality product that is very competitive. It's much lower in manganese, lower in magnesium, and much lower in copper and iron than the competing products. So this will be a premium product. We've paid a lot of attention to tailings management. It's a real issue in the mining business these days. So what we designed in our engineering study was centerline construction. It's an expensive form of tailings management facility, but it is world-class in safety. So we're in an area of very low seismic risk. And there's another element to this. We've talked a little bit about CO2 sequestration, and I'll talk more about that later. But if you spread out our tailings, which are basically silicate sands, in beaches that are exposed to the atmosphere, which is what we're planning to do here, that sand will absorb CO2 and lock it away basically forever in mineral form. The silicates convert to carbonates, and the CO2 is gone forever. And it's just passive sequestration from the atmosphere. But the other thing that happens as you're doing this is there's a process of cementation. So what we scatter as sands will gradually harden into a form of cement. And so this will be an extremely secure tailings management facility. Nickel prices are historically, as you can see, quite volatile. What we did is we looked at 40 years of nickel prices historically, but corrected them to account for inflation to $2020. I was surprised to see the average price of nickel in the last 40 years is $11 a pound in 2020 dollars. The nickel market has fundamentally changed in the last few years and is continuing to change because there is a new source of demand. Traditionally, on the order of 70% of nickel went to the stainless steel market, and it's still, very close to that. But you've got this new source of demand caused by the rise of electric vehicles that is completely changing the nickel market. And it's quite incredible when you look at it. The estimates that I've seen, and which I find credible, about electric vehicle growth mean that you need, by 2040, 40 to 70 new large mines to come on stream to supply nickel, just for electric vehicles. So that's pretty challenging. When I say large, I mean mines on the same scale as Turnagain, call it 35,000 tons a year of nickel, plus or minus. That's a large mine. And you need 40 to 70 of those. To my knowledge, there's maybe 20 deposits in the world of that scale. And there's probably more hidden away that I don't know about, but not many. And all of the large undeveloped deposits of the world are sub-economic at low nickel prices. But we, compared to the other undeveloped deposits, are quite competitive economically. So this shows the economics based on our recent PEA. And as an investor myself, as an aggressive investor myself, this is the sort of picture that I like to see because it shows leverage. When you've got a very large deposit that is marginal economics at the low end of the commodity price range, the leverage in net present value, if you catch a rising market in that commodity, the leverage is phenomenal. And so you're looking for much, much higher returns than you would look for from, say, a producing mine with this type of investment. You're also taking on more risk. But this is the sort of thing that I personally like. So as you can see, this is a chart of the depreciated net present value at a discount rate of 8%. You can see that we go from a negative PV8 value at the pricing that was done and assumed in our PEA. If you take the nickel price to $10 a pound, which is below the long-term average price, you get to about $500 million US of PV8 value. And if you take the price to $12 a pound, you get to over $1 billion discounted net present value. And all of this, our current market capitalization is about $30 million Canadian. So this is the picture of leverage. And if you like that kind of thing, I don't think you're going to find better leverage than this anywhere. A lot of our competition to produce battery materials, battery grade nickel and cobalt for the electric vehicle market is laterite deposits. A lot of them located in the tropics, a lot of them located in the Coral Triangle, places like Papua New Guinea and Indonesia and so forth. And these laterite deposits are processed into battery grade materials using high pressure, high temperature acid leaching. Short form is HPAL. These projects have been built mostly by the Chinese in recent years, and they're being built despite the fact that they're sub-economic at current prices. But this is a cumulative cash flow model of our project versus some greenfields HPAL projects that are on the boards. And as you can see, at $7.50 a pound nickel, which was our base case pricing, nickel's currently between $8.50 and $9 a pound. Our cumulative cash flow is superior to an HPAL, and all the other metrics of financial measurement are superior as well. It's an interesting question. These projects are getting built by the Chinese. Why? Well, my theory is that these projects are getting built with an internal rate of return of like 1 or 2%. Pre-tax. But the Chinese have a very low cost of capital and they're thinking strategically. So they want long-term supply of nickel at a price they can predict. And that price, in this case, if you own a mine, your long-term pricing is your cost of production. So they accept a low rate of return, use cheap capital to build these things, and then operate them. And they have secured a long-term supply of nickel and cobalt at predictable prices. This is going to give them a competitive edge in the battery business and the electric vehicle business. And, what I say is Western companies that are in the battery business in particular should watch out, because the Chinese are coming for you and they've got a competitive edge because they have thought so strategically. Some other comparisons with laterite deposits. We will be an open pit mine, which is a deep hole in the ground. It's hard rock. And so you don't have erosion and, all those sorts of problems. Laterite deposits are strip mines. They're not open pit mines. So they're thin deposits of soils, and you strip mine them. And typically, in the Coral Triangle, in the Pacific, you're stripping down rare tropical rainforests to get at the dirt. Then process this dirt using high pressure, high temperature acid leach. And these power hungry processing facilities are often powered by coal. And then they dump their tailings into the ocean, a lot of them. So, in terms of environmental standards, what we're proposing, you cannot get metal out of the ground without having an impact. However, our impact on the environment is much, much less than these laterite deposits. And in terms of carbon intensity, sulfide deposits by their nature are less carbon intensive than laterite deposits. And if you take laterite, make it into nickel pig iron, which the Chinese are doing in huge volumes. Nobody's done this yet with nickel pig iron. But if you were to take that nickel pig iron and convert it to matte, which is the only way that you could process it towards battery grade nickel, your carbon intensity is almost 60 tons of CO2 equivalent per ton of nickel produced. It's just off the scale. So this shows where we sit in the carbon intensity of probable nickel projects. And this is just with a diesel fleet without any enhancements. And I'm going to talk about some of the enhancements that we're contemplating. In our PEA, we modeled what our carbon intensity would be. And using a diesel fleet, that would be 2.24 to 1. In other words, 2.24 tons of CO2 equivalent per ton of nickel produced. If you use an electric fleet, which is not available yet, but which the market is moving towards and which we will use if that fleet is available, that gets your carbon intensity down to 0.69 to 1. And then using empirical data that we've got from test work on Turnagain material in conjunction with the University of British Columbia to model passive CO2 sequestration, we can get our carbon intensity to less than 0, which is quite remarkable. And this is for scope 1 and 2 carbon emissions. We've got a pretty strong board here, actually, and I'd like to draw your attention to a couple of our directors in particular that have joined us the most recently. Martin Vidra, who is a director, he's also become our president fairly recently. He had a 31-year career with Sherritt International. He's an engineer and he ran their refinery, and so he understands all the processing of nickel extremely well. But he also spent a good part of his career selling nickel and cobalt products to end users. And so he knows all about the various forms of nickel, who wants them, who wants nickel in various forms, and who the end users are. And they know Martin very well. So in our discussions with strategics, with the aim of bringing someone on board to invest at the project level, Martin is leading that for us. Now, also on the board, we've got Bob Morris, and he joined our board about a week after retiring from Vale. Vale is the huge iron ore company out of Brazil that is the largest single company producer of nickel in the world. They're the company, you'll recall, that took over Inco in Canada. And Bob was in charge, he was the executive vice president in charge of worldwide sales of base metals for Vale. So that was copper, nickel, cobalt, and precious metals as well. And depending on commodity prices, that was a portfolio that ranged from $5 to $8 billion per year. So again, we've got somebody that knows the end users, and we've got somebody that the end users in turn know very well and that have dealt with and that have established a relationship with over many years. Both these people came to our project because they believe that we are a project that the world needs and that the end users need for various reasons. So I'm very proud to have these gentlemen on our board. This is our share structure. Our market capitalization, as I say, is about 30 million Canadian. At that price, if you are an aggressive investor, you've got a lot of leverage here. This sort of leverage isn't for everybody, but if you're looking for leverage, this is where you find it. So why invest? Well, very large deposit, and it's open. We haven't drilled the whole thing off. We make a beautiful concentrate that we can sell to a smelter, or we can further process it to other materials that we think the battery makers will need. And you're going to need a lot of these kind of projects to come on stream over the next 20 years. And particularly if you're looking to source ethical nickel that's produced using the highest environmental and social standards and with the lowest possible carbon footprint, you've got a problem. There's not very many places you could find that. So if you're interested in learning more, let's talk. Thank you very much for taking the time to listen.